It's Friday, November 21st, 2025, the week before Thanksgiving. My name is Dano, Weir, and you are about to go on the markets with Fermata Advisors, Sonoma Wealth, the Fermata family of brands. What an interesting week in the market. Again, back-to-back weeks. We've got a lot happening. We had earnings come out, and we have a report of leaked documents from OpenAI. We'll take a look at those and what they may or may not be hinting at. U.S. stocks are expensive is a very common and true refrain, but would you be stunned to find out that we're not the most expensive in the world? What country beats us by 5x? And do rough weeks for Microsoft, Tesla, Nvidia, and Palantir mean the AI bubble is real and leaking? Or did key support help ease some fears for now? Let's find out.
The stock market, the economy, your money. What's the latest and what could be next? Find out now with Fermata on the markets. Straightforward financial market updates for the brands of Fermata Advisors, Sonoma Wealth Advisors, Fermata 401k, and Fermata Tax. On the Markets starts now.
Let's bring them into the show. They are the managing principals of Sonoma Wealth Advisors, Chris Sipes, CFP, Daren, Blonski, CFP. Guys, I got to apologize. I got the first cold of the season, and you can hear it in my nose.
You sound nasally, Dan. Nasally. Just nasally.
Sorry. You got to bear with me. Blame it on the kids.
The benefit of the virtual world is there's no way I can get it from you that I know of, Dan. So
that's right.
That's fine.
That's coming too. That's next that's the next AI feature we'll talk about. Next week is Thanksgiving, Chris, and let's start with a meme that it's a little bit of dark humor, but it's pretty funny. 1,001 days in the life of a Thanksgiving turkey.
Yeah, this of course is from Nassim Taleb and his somewhat famous book in the financial world, at least, about black swans, and how a black swan is something that nobody sees coming, and how they affect markets. And of course, he's a volatility trader. Essentially, they have funds that do well when those black swans hit, right? And to illustrate his point, he talks about the life of a turkey. And let me just read what he says, because this is my sick humor, Dan. Every time we get close to Thanksgiving, I think of this quote. So this is the famous Thanksgiving turkey example from Nassim Taleb. He says, "Consider a turkey that is fed every day. Every single feeding will firm up the bird's belief that it is the general rule of life to be fed every day by friendly members of the human race, looking out for its best interest," quote unquote, as a politician would say. On the afternoon of the Wednesday before Thanksgiving, something unexpected will happen to the turkey. It will incur a revision of belief. And it's just a great way to illustrate a concept that's maybe not easy to understand for most people, including myself.
So as this applies to investing, expect the unexpected, and we can be happy with what we have, but when the unexpected happens, you shouldn't be too surprised.
Correct. The most maybe famous disclosure of all is that, past performance is not indicative of future performance. However, we as humans definitely look at the most recent past to extrapolate what's likely to happen next.
Yeah, Daren, I was going to say that's recency bias, right?
That is.
I'm learning this stuff.
Hey, but so so there's a black swan and a gray rhino. What's a gray rhino?
That I don't know.
That one? Chris,
No.
have you heard about the gray rhino?
That's one. What is that one? Like the one that kind of everybody sort of expects can happen sometime, but you don't really know when. So that would be more like the pandemic.
No, that would be more like the screen right now. Leaked documents shed light into how much OpenAI pays Microsoft. And this weird, everybody's questioning, wait, so Microsoft's giving $1 billion to OpenAI, who's giving $2 billion to Nvidia, who's giving $2 billion to this company, but they all have the same auditors looking over their balance sheets, and no one really knows whose money's whose money and who's actually getting the money versus saying they're getting the money. And that would be called a gray rhino because we're talking about it, where a true black swan that you were just talking about, you don't see it coming. So this OpenAI bubble, AI bubble thing that we've been mentioning for months now would be considered a gray rhino.
And that was the news this week. This is an article from TechCrunch that purported to have seen leaked documents from OpenAI. So if you're trying to follow all of this, as I am, guys, the real mystery around all this is that OpenAI is a private company. And so they'll say things like OpenAI is valued at 500 billion, or it's valued at whatever it's valued at. But since they're a private company, they don't have to share earnings, and they don't have to share a lot of the information that one of their big financiers, one of their big backers, Microsoft, does. And so there's sort of this mystique around OpenAI, and we know that it's doing some really unbelievable things with video. People are talking to it. It's purporting to be the new infrastructure for all of human existence. So that helps beef up the price, but we don't really know a lot about it. Well, this document that that TechCrunch got a hold of did look at income that OpenAI paid to Microsoft as part of their arrangement, and they're able to extrapolate from that document that OpenAI's revenue was around 3 to 4 billion, which would have been below the 13 or 14 that they've been saying that it's at, which even that number is below what they believe their costs are. So in a piecing together all of the puzzle pieces kind of way, this document this week at least is seeming to indicate that OpenAI is providing a bunch of free computing basically at an unsustainable price and not making that much revenue is what this is indicating.
Yeah, it's we talked about last week, maybe 2 weeks now, where the narrative around AI is starting to shift a bit. Right, it's going from the AI. There's nothing AI can't do. Right, it's going to change every single thing. The sky's the limit. Buy everything that you can get your hands on that has to do with AI. To wait a second, this build out is pretty substantial. Now they're starting to borrow money. We saw Oracle fall over the last couple of weeks, and they basically lost all the market cap that they had gained after they announced their deal with OpenAI. And so some of the narrative is starting to change. Google released their own AI product that is basically saying like, hey, we don't really actually need the NVIDIA chips. And so that's sort of revealing the commoditization of those chips, that there's not really that much of a moat around that business. So there's some cracks in the dam there, but who knows? We never know, right? What's right around the corner with these stories.
Well, and I believe that China came out this week with a chip that was going to compete with NVIDIA's chip. So it was that supposedly that China didn't have these chips that could do all the cool things NVIDIA could do, but oops, maybe not. And I think that's just and let's contextualize this in a larger picture, but you have to, I think, all of us have to sit and think about what is the bigger picture here, right? And I think this feels almost exactly like it felt in www.com era 2001.
Absolutely.
It has the same vibe. It has the same internet's going to change our life. Now, let me be clear. I absolutely think AI is going to change all of our lives drastically, but that's not before we go through the S curve of adoption and we see a lot of carnage for the first run of it.
Chris, I did this just for you because what has been happening with all of this, okay, you give me the chips and then I give you 300 billion and then you give me 150 billion. I want to go live right now to OpenAI's accountant who is playing the 4D chess, Chris, that you have always talked about. This is 4D chess from Star Trek. So enjoy that.
Beautiful. Nice.
It's basically what they're doing.
The master of memes. We spend a lot of time talking about this concentration, about the AI story, because from a market's perspective, it does matter. It has a big impact on the U.S. equity markets specifically, given that most of the earnings that we've seen here in the last few years has come from that handful of companies, which has pulled up the whole rest of the market. But hopefully the theme that you'll kind of see this week is that there's a lot of opportunities or potential opportunities elsewhere. And, I'm still not letting go of the possible theory that we've already been in a recession and are in a recession now, and that a lot of asset classes have already priced that in, and maybe we're starting to see some rebound on the other end of that, but it was just masked, and that most people wouldn't have thought it was a recession because the U.S. stock market went up and because housing prices stayed high.
Is that why the government refuses to report the jobs data?
I don't know if those two things are related. I am not.
Okay.
I am not sure. But I don't know if the new BLS person is going to be there very long. Not doing so hot so far. But anyway, we wanted to look at this from Visual Capitalist just to get an idea of the share of the world economy. Now, this is not markets. This is we talk a lot about that, how the stock market, the bond market, the commodities markets, the financial markets in general are not the economy. While they're loosely correlated, they're not the same thing. And so when you look at the global economy, so like what's actually, the productive means of business around the world, the U.S. is actually a pretty small portion of that overall economy, only about a quarter. Now, we make up about 70% of the global stock market value, but our GDP and economy is only about a quarter. So there's a lot of opportunity outside the U.S. Now, that little red box, which is really, you can't even see it there, that is measuring the growth of China. And from 1960, they went from 4% up to 19% in 2019. Now, this doesn't account for post-pandemic, which is obviously probably the most important 5-year period in that time frame from a markets perspective. So it'd be interesting to see what this looks like fast forwarded 5 years there. Price to earnings ratio, a good way to visualize that when they put this with this is from Global X. They're a fund provider, so they do have some, I guess, somewhat of a dog in the fight here. But if you look at price to earnings ratios around the world, you can see emerging markets ex China are only 15.9. You've got the developed markets kind of there in the middle, along with Europe at right in the 15 to 16 range. Canada and Australia are at 20. But then down there at the bottom, you see the U.S. at 27.5, which is fairly high relative to where it's been historically. Not the highest, though, in terms of countries. You see there New Zealand at 101.4. Dan, don't ask me why it's at 101.4.
I won't.
There are some rabbits we cannot afford to chase. I would not be able to get anything done during the day if I chased that down. Although, believe me, I did look at that and go, I wonder why. And I wanted to chase that down, but had to leave it.
Chris, I know you love foreign stocks, but I have to say I'm going to allow you some reprieve. You do not have to be an expert on New Zealand.
Well, hey, look, I don't love anything when it comes to assets. I am a believer in diversification, and foreign assets just happen to be, priced in a way that is somewhat attractive relative to history. Now, we've talked about this for a while, where price does not matter in the short run. It's not a predictor of returns over the short run. It's barely a predictor of performance over the long run. And so Antti Illiman from AQR was on with Meb Faber this week, and he talks a lot about that, about how a lot of returns are actually driven by sentiment. So the fluctuation in these prices, which is just people's expectations of the future there. And so the U.S., there's been many times where people were pretty down on the U.S. and those price to earnings ratios were very low. And now they just happen to be very excited about the U.S. and pricing in U.S. exceptionalism. And so those prices are high. And so those can be a big driver of returns in the asset markets over even somewhat long periods of time, like 10, 15 years, like we've seen recently. Okay, so we got our sentiment indicators this week. The AAII indicator, not all that telling this week, somewhat normal. The bearishness dropped off. But listen to this, guys. The CNN Fear and Greed Index down to 6. Extreme fear.
Ooh.
I can only remember one other time where I think it got down to 4. I believe that was in April, where I've seen the dial that low on the dial. So my contrarian, indicators, that one's going off. Same with Bitcoin at 14, extreme fear. We saw Bitcoin drop down into the 80s this week. That's down from 16, so it's been in that extreme fear zone for a while. Whenever you hear extreme fear or extreme greed, those tend to be contrarian indicators, although I can tell you it never feels like an opportunity in the moment, right? The feeling around the asset class is always blah, right? We call it the puke point for a reason. Now, Bitcoin, this from Charlie Biello. He put this out a couple days ago, so it was at 86,000 at the time. It's, I believe, lower at the moment, but he says at 86,000, Bitcoin is now down around 32% from its all-time high of 126,000 in early October. That's the biggest drawdown since April, but not unusual at all given its historical volatility. So, like Daren's talked about many, many times, hey, if you're an investor in this asset class, you better be ready for a wild ride. It's going to happen, and that's just the nature of this asset class. Who knows what's driving that? My best guess is something like global liquidity. It tends to be the front end of the risk curve, which I believe is driven by, in large part, by global liquidity, which from some sources are saying that is turning down right now. And so Bitcoin could be an early indicator of that. But anything that you're going to invest in that's going to have super high returns when things are good are also going to have super big losses when things are not so good. So 35% or 30 whatever percent for Bitcoin is really merely a flesh wound, as they would say.
Daren, what do you think about this?
I think it's just is what it is. It's a feature of Bitcoin. You shouldn't touch Bitcoin unless you're okay with that.
So what happened today? Why the big reversal in the market? Or at least what's the narrative that everybody's tying to it at the moment? Because we had a pretty rough week in the markets overall until today. We got this big green day in the markets, and that you tend to see big reversal days when you're in a downtrend. Some of the biggest gain days happen on when you're in an overall downtrend, which we'll see later when we go through the candles. But the Fed Chair Williams came out and spoke. And so what you're looking at here is the Fed funds futures from the CME. And it's now up to a 70% chance that we will see a rate cut at the December meeting on December 10th. Now, if you look at this chart from Jim Bianco Research, I think it illustrates it very well, where you can see the probabilities of the rate cut were very high coming into November. It was almost a lock that we were going to get a rate cut in December. And then through a series of non-releases in the market around jobs and inflation, et cetera, the market started pricing in maybe a 50-50 chance that we would see a rate cut. Well, that jumped today, and that's based on Fed Chair Williams. So let me just read this from Jim Bianco. Williams' speech this morning dramatically changed the outlook for the December 10th FOMC meeting. We have been arguing that the FOMC voters view their role as changing and strongly signal that they will vote independently, not fall in line with the chairman's wishes, chairman being Chairman Powell. And this is a positive development. So Fed watching is now akin to whip counting or tallying up the voters' public comments to see which view has the majority, which is 7 votes. The current tally looks like this. 5 voters have strongly signaled they do not want to cut rates next month, which is Barr, Masalam, Schmid, Goolsbee, and Collins. 5 voters have signaled that they want to cut rates, which would be Moran, Waller, Bowman, Williams, and Cook. 2 voters are unknown, Powell and Jefferson. If the Fed is truly becoming independent, then it should be a 7-5 vote either way. If the voters cave and revert to history, voting 11-1 or 10-2, without a stock market crash changing the equation, the FOMC members who are not the Fed chairman will wreck their reputations. So Williams, it was a big deal for Williams to come out and say this morning because he's kind of looked at as a lieutenant of Powell. He's looked at, basically like he wouldn't say this unless he was comfortable voting that way for the rate cut, because he usually lines up with Powell. So that's why it's important. And with that, small stocks rallied hardest. Small value saw a huge gain today. So those stocks that are much more dependent on credit and the price of credit, it matters a lot more to them whether or not the rate cuts come. And so you saw a big rally in the small stocks this week. Now, we also got the sentiment, the U.S. Index of Consumer Sentiment from the University of Michigan. And this is what I'm talking about, guys, with the possibility that we're already in a recession at the moment. When you look at this consumer sentiment, it's pretty easy to tell. When you go back all the way to the 50s, we're in the doldrums when it comes to how people feel about the economy. Now, it's been this low before during the massive inflation in 2021, but we're actually lower than we were during the Great Financial Crisis, which is that gray bar there in 2009, in 2011. We're lower in terms of sentiment, and the consumer sentiment matters a lot because so much of our economy is driven by spending. And if people don't feel good about the economy, they're less likely to spend, right? And so we've kind of been in this low sentiment now for a while, really. I mean, we had a brief respite from it, kind of coming in, going into 24, but then since 24, the end of 24, we've really dropped off and we're back down into the doldrums when it comes to consumer sentiment. So far, that has not fed through to spending. And we talked about that being most likely because a lot of the spending is driven by the top 10%, and they hold all the assets and the markets continue to do well. That top 10% of the U.S. spends about 50%, does 50% of the spending. So they matter the most when it comes to consumer spending. But nonetheless, underlying economics. And I feel this way just from anecdotally talking to clients and such. A lot of people seem to be losing their positions, getting downsized. People are worried. Definitely not all that jazzed about the economy at the moment.
Chris, it almost seems like we've got equal parts of the dot-com euphoria and 2008 happening all at once between the market and the economy right now.
Yeah, wow, Dan, way just to spin it uplifting, buddy.
Well, I'm sorry. There's sort of like it's like this is the third act in the trilogy or something like that, where the first two combine. It feels like we've got a little bit of both.
Yeah, I agree with you. It's very confusing. From a market's perspective, everything is fine, everything is great, and yet nobody's happy, right?
Right.
So it's a very strange situation, because normally when people feel this badly, the market's also in the tank, and that's just not the case right now. So now we've got home sales. This is another one of those charts that, look at this. We're down where this is existing home sales going back to before the year 2000. And you can see our existing home sales are down where they were during the Great Financial Crisis, which was a real estate driven recession. Remember that was like as bad as the real estate market has ever been. Well, guess what? We're back down there, and we have been down there for a while. in terms of the existing home sales. So prices are still high in the real estate market, though, and so people don't feel the same way they did in 2008 when home prices had dropped by 25%. They don't have the same feeling about the economy when it comes to the housing market because those prices are still high, right? And so it's another area where it's kind of been masked or hidden, what's happening under the surface. And I can tell you from working with a lot of people in the real estate business, on the mortgage side, on the real estate broker side, and they've said to me, look, this is worse. This feels worse than 2008 did for me, in terms of the business that they're going through. So I mean, it's definitely hit that segment of the market and has been there for a while, as a kind of a rolling recession. We look at the housing. This is the National Association of Home Builders and the Wells Fargo Housing Market Index. Another one. It's not quite as bad as the Great Financial Crisis because this takes into account other aspects of the market. So this is a little more of a kind of holistic looking index when it comes to real estate. But still, whenever you've seen a drop off like this, we've been in a recession, which is those gray bars. Now, on the plus side, we're seeing a little movement up. As you can tell, we've seen a few of those little movements up, so it's definitely not a trend yet. But maybe we're on our way where we can kind of get through this. These things don't last forever, thankfully. However, I think there's a real argument there that at least in the housing market, as one example, we've been in a recession for a while. Private investments. Dan, you mentioned OpenAI earlier. These are a few private equity. These are companies that are publicly traded, so their stock is public, but they are private equity. They're involved in the private equity space. So some of the largest ones being Blackstone, KKR, Apollo, Carlyle. And this is year to date, okay? Year to date, all seeing a lot of signs of stress, especially Blue Owl, which is a little bit more in the real estate space, office buildings and such. And they're down 40% this year. So wow. Starting to see a lot of signs of stress in the private equity, private credit space. As you probably know, they are trying to bring private equity and private credit investments to people's 401ks. I'm not so sure how I feel about that.
Why is it always that they're trying to change it up and get access to new capital when they're in trouble, right? They just take advantage of a bunch of unsuspecting investors and let them buy private credit garbage in their 401k.
Yeah.
Now, there's a genius idea.
Jem Carson said that this could end up backfiring. I think he had a great take where he's talking about the fact that the illiquidity that has kind of been a hallmark of the private market. So one of the advantages is they can say, look, I don't really have all that much volatility because they don't have to mark to market. They don't have the daily liquidity and the daily pricing like you see in a public market.
Explain
right?
Mark to market a little bit more, because I think that's an important point.
So mark to market means that the price is telling you what those shares are exchanging at. So what is a willing buyer willing to pay a willing seller? What price are those shares exchanging hands? That's a market value, right? Now, if you have an asset that somebody just says is worth, $1 million, and that's just like, hey, I think it's worth $1 million. Well, that's not necessarily a market value because you don't know that asset is worth it until there's a willing buyer willing to buy that from you at that price. So these private investments don't get marked to market. They don't have that volatility. But conversely, bringing those assets into 401ks, bringing these private assets to the masses could force there to be more liquidity, force there to be more of a mark-to-market situation, which could be not great if you're looking at the fact that some of these companies are down 20 to 40%, while their underlying investments might not really reflect that at all. So it's interesting. Great odd lots episode this week. Two of them actually. Cliff Asness from AQR thought that was an excellent episode, and then they also had Jeff Gunlock on, and he is in the fixed income space, and he was very, very bearish on private debt, and so if you get this in your 401k, be careful. Know what you're getting into. Know what the underlying liquidity is or is not in this case, and just buyer beware.
Chris, one thing before we switch slides, and you don't know, I'm sure, off the top of your head what's in these private equity firms' portfolios, but they have to have put some money into AI in the last year or perhaps this summer. So could something like this be an indicator also of, a bubble leaking and stress in that particular category?
It definitely could be. Yeah. Yep. Definitely could be, because if you think about where's most new money going into, right?
That's what I'm saying. Where is it coming from? It's coming from private equity. So they placed their bets last summer, and then now we don't know those portfolios, though.
Yeah. Now, going back to the fact that, hey, maybe there's some other opportunities out there, and maybe we've already seen this recession and are in it, and we're starting to see some recovery. What you're looking at here is the, I'm not sure why this slide doesn't look to be framed correctly. Am I just seeing that wrong there, Dan? Are you guys seeing the full slide? Or
I'm not. I'm working on it right now. I'm working on fixing the moment.
Okay. So while you're working on that, what you're looking at here is the dark blue line is the Russell 2000, which is the small U.S. companies, small cap companies. And then you've got the gray line, which is the mid cap, so medium-sized U.S. companies. And this is a 4-year chart. So going back to this time in 2021, November of 2021. And what you can see is that, the small caps are barely above where they were 4 years ago. So the small caps have spent 4 years in the wilderness, right? And are just now starting to pop out of that. Who knows if this is a trend on the upside, and we're going to continue to see recovery in those small caps. But small U.S. companies, the ones closest to the ground when it comes to the economy, have already been through their pain. They've been through an extended period where there's been no returns for quite a while, and the mid cap companies are not that far ahead. So they're essentially flat over that 4-year period as well. So looking forward, possibly, because a lot of times what happens is that you'll see a recession, and then but the market starts to recover mid recession, right? And you start to see the markets doing better, the financial markets doing better, while the economy continues to languish, sometimes even deteriorate a little bit further. But because financial markets are forward looking, they are going to be recovering first, right? So if we did go through a recession, and if we are in a recession now, and you're starting to see these other assets recover, that would make sense. Now, same thing here with dark blue being foreign developed stocks. So similar returns to U.S. mid caps, and then you got emerging markets, which emerging markets are considered a lot more like the U.S. small caps, where it's like higher risk, higher volatility, etc. So both of they're pretty close to the same returns as the U.S. small caps. So global stocks, if you take out the large cap US, and which is basically taking out that handful of AI stocks that have done so well, have largely gone nowhere for the last 4 years. But they're all starting to break out of where they were 4 years ago, which is a good sign. So might be a regime changing under the surface here. Now, why have those large cap U.S. stocks done so well? Well, because the earnings have actually done well for them. So the dark blue here, large cap U.S. Earnings, you can see that really took off kind of early 23, which is when the stock market also took off in the large caps and the Nasdaq. So those earnings have trended upwards over that time period, while you can see with the mid cap and the small caps that sideways motion. So the stocks have just followed the earnings sideways. Now, who knows? That side, if you look at this chart, it's 25 years. So 1 year on here is really, even though it feels like when you're going through it, it takes a long time. It's the investing dog years, right? But when you look at it on a chart, a year, 2 years, 3 years really is not much in terms of investing time. Now, when you look at the valuations, so this is expectations. A big part of the valuations is, what do people expect moving forward? What's priced in? What are the odds? You're going to bet on football on Sunday, and
Don't do it.
Pretty much,
Don't.
Any team is playing. My team is the Browns, right? So pretty much any team that's playing them is going to be favored or should be favored, right?
You're such a good soul.
Browns? Like, what's wrong with you, Chris?
You're such a good soul.
Are a total emotional roller coaster, because on Saturdays I watch the Buckeyes, who probably have the best team in my lifetime this year, knock on wood. So they are hitting on all cylinders. Sundays I turn on the Browns and just think to myself, how can they lose this game? Oh, that's how.
Ohio
What could
considered the
possibly
home
go
of
wrong?
football, the home of the Football Hall of Fame, has two of the worst pro teams. Anyways,
Yeah. So anyway, but going back to the betting, like, look, those odds are priced in. So the valuations on the large caps. So notice how much higher the valuations are on the large caps versus the small and medium, and look at the past times that's happened, where they tend to kind of follow along with one another. But if you go back to when the large caps started their run in the great financial crisis, and you look at those valuations, look which segments had the highest valuations. It was the small and the medium sized companies, while the large caps went on to trounce both of them from that low point in 2009. So anyway, it's, there are lots of opportunities out there, and just because, there's a handful of stocks that may be overvalued and whatever, doesn't mean that there's no opportunity in the markets. There's always a bull market somewhere, as they say. And as a narrative check, I was surprised to see this. This is from Ed Faber by way of UBS. The AI Capex remains low in GDP terms relative to some of these other build-outs. This was pretty cool on versus UK railroads. Look at that. I mean, if you think back to that time, just imagine the life-changing nature of railroads. I know we're sitting here with AI going, oh my gosh, everything is going to be different. Can you imagine what life is going to be like? Well, people have had those technologies in every phase, and going from basically being completely disconnected from the rest of the world to having a railroad was one of those events. So it's pretty amazing. But you look at this on a relative basis, and the AI Capex projection is actually not all that crazy compared to some of these other even ones that we had in the 90s. So there could be a long way to go on this Capex build out. There could be a long way to go on the valuation story and the U.S. exceptionalism, et cetera, et cetera. This could be a short-term blip.
Chris, I'm glad to hear you put it that way, because last week when I was talking about the AI build out cost versus the cost to put a human on Mars, I thought of the same thing. What was the railroad build out? They can't even calculate it. I mean, they can't even calculate what it actually costs to build the U.S. railway system to the point where it became profitable. And then, by the way, we moved on. You know, it was a thing. It still is a thing. But then there was something else. So
that's right.
We're in the next phase now where it's the AI build out.
That's right. So that's the end of the economy charts this week. I don't know if Daren wants to jump into candles and go through some of the technicals.
How did you know, Chris? I'm just itching here looking at these candles.
There we go.
They're so exciting.
Hand it off.
Look at that.
We always say that. We always say that, Daren. In case anybody doesn't know, when we say, "Do you want to show some candles?" What does that mean? What are you talking about?
Well, it's all about time frame, Dano. It's all about time frame, and the candle of the day is going to be a shooting star. So let me tell you about a shooting star. And now everybody's like, "What kind of French are you talking?" So if you see this, let me tell you about the structure of a candle. So a candlestick represents a time or a period of time in the market. And so in this case, we are looking at the 4-hour chart. So this is if you take one trading day and divide it by 2, you're basically going to get a 4-hour chart. And you can see in the first part of the day, so this green candle was the first part of the day. This green candle is the second part of the day. And when there's a long shadow, or wick is another term, price moved up during that trading period and then sold off and went back down to the lower third of that distant or that candle, or the lower third of price action for the day. We call that a shooting star. And it's usually a topping candle. And here's why it's not good for our money in the markets. So what happened today is that yesterday we had this really ugly red candle that sold off. And then today the market opened up right here. There was some down and then it went back up, went all the way up to here, but got rejected and came back down to close, still to print a green candle, but a green candle inside of a red candle isn't necessarily a good thing. So the financial media will tell you today, oh, the market was up today, and everyone will breathe a sigh of relief because the market was up today. But that's not necessarily meaningful. It's just day-to-day volatility. What I see on the chart is this descending triangle formation right here. This would be called a descending triangle. What happened yesterday is it broke out of that descending triangle and broke down. Descending triangle is often a sign that the market might be heading down. I also see something interesting, which might be more positive for the market. You can see a double top here, which is a topping pattern. And it looked like that double top was going to fail, and it came back in, and now it's hugging this area or this level of support that was important here, 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 and now it's important there. The more times price action visits a particular area of the chart, the more likely it's going to move through that area of the chart. So I think, unfortunately, the risk is still to the downside after this week. So that's the big point. The other point is that it is finding support, though, in this general area, albeit not a lot of support. When it did try to move up during the last 4 hours of the trading day, it moved up and got rejected. What does that mean? Rejection means that buyers start buying and they get tired of buying, and then the sellers start selling. So rejection says, no, I don't think the market's going to go that much higher, and all the sellers step in. What's interesting is this blue line is the 200 4-hour moving average. So if you take the market and divide it into 200 4-hour segments and then divide the price by itself, you would plot this line here. And that line, you can see it landed, it found support right on that 4-hour 200. So Chris sent a note to me earlier today and said, nothing good happens below the 200-day moving average. Well, good news, Chris. We hit the 4-hour 200, the 200 4-hour average, and we found support. But where
that is good news.
That is good news, right? We'll take that. The bad news is when it hit it and bounced, it got rejected and printed a shooting star, which is often a topping star or a topping pattern. The other piece to look at, so if we were going to put a neckline on this double top, I would probably put it somewhere around like right there. So you could argue that maybe found support on the neckline of that double top too. So that's positive, right? On some level, that there are buyers stepping in here saying, I'll take a nibble here. So let's look at the chart on the daily. So now these are candlesticks on a daily. So this it represents 1 day in the market. And you can see support along this important support line. The 200-day moving average, which is pretty important in the stock market world, is all the way down here. So we're pretty far away from it at this point, which I guess is a good thing. The longer price stays down in this area, this moving average, though, will slowly start creeping up and it will come in contact with it. If it stays kind of flat where it's at right now, you can see how important the 200-day moving average was right here when we had the tariff freak out earlier in the year. And you could see rejected, went down some more, came up, and then went right above it. And we haven't tested the 200-day moving average in quite a while. So it would not be utterly shocking to see a test of the 200-day moving average. It's a really important moving average for the entirety of the market. Let's look at VIX. Maybe VIX has a clue for us. And what do you see? You see building volatility right here, meaning it's moving up. When we see building volatility, that can be a sign that there's something brewing in the market. The VIX is a measurement of how complacent those who trade the S&P 500 futures are. So when they start trading a lot of it, it means they're less complacent, and that's usually because there's some volatility in the system. You can see here was the tariff tantrum right here that we saw earlier in the year. And you can see, though, it builds and then it goes down. I would say one of the positive things is we still have a downward trend in volatility, but it's pinching like an ascending triangle, which would tell me it might be breaking out. Looking to me like we're probably looking into January, February, I would be expecting some volatility based upon the way that's reading right now. All right, there's going to be the 10-year. Why is the 10-year? Because it's all important for all these things we do in the economy. And we look at the 10-year moving average on a daily chart, and you can see it's still hugging this support. Interestingly, though, one could argue a couple things here. One, that we've got a double bottom right here, which would tell you the interest rates are headed back up, which would be pretty interesting if they went up right now. You could also argue we have the beginning of a double top. But the fact that it's came into this support trend line, it went below and traded above it, and we're back there, and we found some support today. Like I said a few minutes ago, the more often price visits a particular point on the chart, the more often or more likely it is that it will go through that area of the chart. Last week, I talked about silver and this double top that was forming in the silver market. And we hung on this week, folks. So we have the 20-day moving average, which is this red line. This is that 200 we talked about earlier. There's a 20-day moving average right there. And we held on and we had our double top. And then we came in and found support. So we'll see what happens next week. It's not a particularly bullish candle. It didn't find that support and then trade up into the green. I want to see some follow through and what happens next week on that moving average. So nothing to report on the silver chart. On the gold chart, very similar structure. You can see that double top. It's kind of trading sideways, which would tell me we're probably going to visit somewhere in the 3,900. We lose the 3,900 level, then we'll probably see lower. Given how far up gold has gone and how fast it's gone up, would not be a shocker. Let's talk about Chris's favorite asset class, loser coin. And in Bitcoin.
Wow.
Wow.
Did he just, this is how he's feeling.
There's
this
a
is
lot
how
of
he's
emotion
feeling.
in that one. Are you okay, bud?
Bro.
You guys. You. Okay.
This is how I am when I get yet another injury on the 49ers and I'm like, this stupid team, why do I even follow them? This is Daren in Bitcoin right now.
You know, I'm actually perfectly okay with it because I like when assets I like go down. I'm not going to tell you why, but I also like a good sell on anything. So Bitcoin has had a pretty rough go. You can see there's a lot of talk about MicroStrategy and Michael Saylor's leverage in there getting unwound. It is in a very precarious spot though right now, I must admit. You can see higher lows, higher lows. Oh no. Oh no. Oh no. Not so typically when the trend is up, we have higher lows, and that is not what I see.
Oh boy.
You can see this area though being a really important support area, and we are hanging out in there. So don't throw the hat in yet. You could also see a massive double top here. The only thing that I would say that's promising on this double top is if a double top's like saying, hey, we're headed down, you'd see a bigger kind of left side and then a lower right side, and that's showing weakness down. Whereas this one, we have a bigger shoulder to the right, or I guess a bigger right side. So we will see. But yeah, definitely looks fairly precarious. But again, like we said earlier in the show, if you can't handle volatility, get out. It is not the asset class to hold if you're sensitive to volatility. Let's talk about Palantir. So Palantir, so those who don't know, it's an AI play, I guess you could say it. And it's Peter Thiel's baby. And they do a lot of government contracting work. No one actually knows exactly what they do. It seems like anytime you read up on it, it's like, what do they actually do? A bunch of stuff they can't talk about. So
I think it's like Salesforce for spy work.
Yeah, I think that's a good way to say it. Salesforce for spy work. Well said. So anyway, coming into their 200-day average, we talked about that. I mean, this has been like one of the meme stocks of the year, coming back in, going from 206 all the way down to 150. That's quite a precarious drop there. Let's take a look at RSP, right? So this is the equally weighted index. We talk about the heat map every week. We show it. And so the S&P shows what the index looks like when you weight the boxes. When it's the RSP, it's the equally weighted boxes. You can see Microsoft and NVIDIA had a rough day, but the rest of the market actually looked pretty good for the day. If we look at it on a weekly chart.
Yeah, show the week.
Ouch. A little bit different. But
Wait,
again,
different.
like
There we go. Yeah.
We could have all this green down here, but if we got all this red over here, like it's just the capitalization is so big. It's just really hard to make up for that differential.
I find it really interesting, by the way, and I'm sure you got a Teams message from me at 2 a.m. on this. If you can go back to that, that it's the summer darlings of NVIDIA and Palantir and even Microsoft, which are getting hit, and some of the tech OGs, Apple's at least flat, and Google way up. It's kind of Empire Strikes Back a little bit.
Yeah, for sure.
Well, NVIDIA came out with their earnings on, I think it was Wednesday night, right?
Yes.
Thursday, the market opens ripping up. NVIDIA was up, I think, over 5% at one point. So the overall market opened up over 1.5%. Plus ended below 1.5%. So like if you check the market in the morning and then you check it at night, you're like, wait, what happened? Right. Now talk about unprecedented times. That's only happened 4 times in history, apparently. 2 of those times were this year, once in April and once yesterday. The other 2 times were in October of 2008. Dun dun dun. So,
and you guys are so negative today.
Just a wild ride, though. I mean, to me, to have the market go up that much and then down that much within one day, I mean, that's wild. So, anyway, side note.
Let's do something positive, Daren. Okay, we got some applause. Okay.
Hey, on the flip side of that, too, on a positive side, 6 months ago, guys, Google was left for dead. Remember that?
Right.
Nobody was going to use search anymore. Google was like this dinosaur company that, you can't believe anybody.
Same with Apple.
It got picked up in the value screens, right? People, in different investments with the value stocks were picking up Google because it had fallen so much. And now look at it coming riding straight back. So this
is interesting. So this is the Dow Jones, right? So when people say the market, are they saying S&P, NASDAQ, Russell, or the Dow Jones? And if you look at the Dow Jones, which is the big 30, this is just crazy when you think about it. The NVIDIA, Microsoft, Apple, Cisco, IBM, and CRM, Salesforce, are bigger than all the other companies. I mean, that's just when you kind of divide a line in half here. Talk about a lopsided market.
Crazy.
You look at NASDAQ, it looks just as ugly, right? So when we track the index, the NASDAQ, it's just there's so much concentration in the market right now that it's going to be interesting to see how it unwinds. And then you look at the Russell 2000, Chris's favorite index. And
It's not.
so it's not really his favorite index. I'm just
I disclose to you guys that I'm a Browns fan, and you just pile on.
And then look at all stocks, which is pretty wild. When you look at this, is the entirety of all the stocks in the U.S. So interesting, though. You look at Microsoft, NVIDIA, Apple, Amazon, Google, still massive portions of the whole entire. I mean, look at these little companies down here, little teeny things. This is the whole biotechnology sector. And then you compare that to NVIDIA. I mean, that just shows you the concentration out there in the market and why it is such a big deal that, like, wait, what is happening in the NVIDIA balance sheet? And wait, what is OpenAI really paying Microsoft? And or is Microsoft paying OpenAI? And who's paying who? And whose chips are we buying? Like, it actually kind of matters. And then we look at the world stock indexes, which is kind of interesting. And so, anyway, I won't go off on that tangent. But
Speaking of rabbit holes.
Yeah, exactly. You guys got me going on that one. So, anyway, so we've got the RSP. You can see a little bit better of a look, though, because we broke up a little higher and we didn't hang out below this resistance right here, and it became support. So I actually like the overall stock market from a risk standpoint a little bit better than I like the S&P right now. Let's take a look at oil real quick. Getting a little long in the tooth here, but you can see oil is still working its way down, which then could be an indication of what Chris is saying, and that is that we might already be in a recession. It just hasn't been called. I feel like we've been saying that for like 5 years, Chris. So I don't know. Maybe we're just now do rolling sector recessions, and then the
market's been sideways.
Okay. Okay.
Yeah.
Let's take a look at the bond market. Bonds actually look kind of interesting right now. I mean, that's pretty impressive, right? Because, like, how often do we hear people just hating the bond market? Over the last couple of years, this has been the AG, which is the index that tracks the bond market, and it actually looks like it's headed up in the right direction. Wouldn't that be something if we actually had a pullback and the AG was actually provided some diversification in and go down with all the stocks too? That would be a shocker.
Don't jinx it.
Yeah,
don't jinx it.
Seriously. Well, I think we're going to leave it there this week. The S&P 500 struggling this week, holding on. I think we still got more down to go. If you want to, I'm kind of looking at this area as a target. We find some support into here, but it doesn't look like it's going to be a great December at this point. And it looks like old Trump's going to pull a repeat on his first term.
Could we look at one thing before we go, Daren?
Sure.
Could you pull up Palantir again? I wanted to look at, because if you listen to this show frequently, as I'm sure you do, I bring the maybe the average investor's approach to this, trying to understand, hey, this is my money. I have my money in X, Y, or Z. You guys are the CFPs. You understand a lot more of the technicals. Obviously, Palantir got smoked this week and has been in a downtrend. And for whatever reason, Chris identified this. My feed is now half 49ers and half meme stocks and tech and financial stuff. If you as an investor had this in your portfolio, you're sitting there like, man, it's in a downtrend. What do I do? Can you pull up Peloton, Daren? Is it possible to pull up Peloton?
You're really going to do that, right?
Yeah. So if you're a Palantir holder, or if you're if you feel like you're holding a stock and you're wondering about a bubble, Just imagine having held Peloton and look where it is now. Right. So I just imagine if that's not my portfolio, but imagine that if it was like, just imagine this. Right. And then one more. Can you pull up B of A? I don't know if you saw this or not, but at the start of the month, Bank of America, just at the start of this month, can you pull all the way back to 2008? Just at the start of this month, Bank of America finally reached where it was in 2008. Before yes.
How's that? Well, no, it touched where it was. But it was up higher because this is the monthly chart. B of A, you can see, came up and it was higher. This is months ago, though, that it came down.
Can you go back to 2008, or does it go back that far?
This is the 2008 right here, which was $36 a share.
Well, even so, maybe if it wasn't this month. But look at that. Look how long it took to bring to get you back to where you were. So my point is that I'm getting at, if you're holding, if you have Palantir, if you have anything you feel like is bubble sensitive at the moment, ask yourself if you're okay at looking with the look of some of those charts. Would you be willing to hold it for that long, or would you be willing to sit down there in the doldrums of where Peloton is right now? I think is a good question that any investor should ask. That's all I'm saying.
So check this out, right? So let's go there for a minute, okay? So let's take NVIDIA, right? Like, I think we all would agree there's probably some type of bubble going on there. To what degree? So you can see when you see these stocks just rip up and then they go down. It'll be interesting. This time's different for NVIDIA, though, right?
Well, it's got to be. This is world changing. This is life changing.
Yeah, right.
So
let's see. This put NVIDIA on a weekly chart. So this is looking at the weekly chart of NVIDIA. This put Peloton. But wait, I thought Peloton was life-changing. We were all going to just ride our bikes all day.
Gyms are gone, dude. Gyms are so 2000 and late, bro.
Yeah. So here you go. I mean, look at that. Like, there are some very similarities there, right?
Yep.
You have this really hard run up and this kind of pull back, then one more run, and then it stalls out.
Mm-hmm.
Very similar chart. So if this is the case, then you would expect that NVIDIA will work down into this range, hang out here for a while, and then peter on down. If it's a similar type of pattern. Who knows? The past is no prediction of the future. But as Mark Twain says, history tends to rhyme.
We will leave it there. Thank you both for a great show. Thank you for finding our show. Thanks for finding us on YouTube, on Apple Podcasts, and Spotify. We are Sonoma Wealth Advisors, the Fermata Advisors family of brands. You can learn more about us at sonomawealth.com. If you're a client, we really appreciate your time. Hope you found this educational. And if you're not a client, you can learn more about how to become one at sonomawealth.com. And we'll see you next show. Thanks a lot, guys.
You're up to date with Fermata on the markets. Learn about how the Fermata Advisors family of brands can help your family and business in finance. Sonoma Wealth Advisors, a comprehensive, holistic finance solution offering financial planning, asset management, and tax planning. Take our free wealth analysis now at sonomawealth.com. Fermata 401k, business retirement solutions for small and large companies with a fiduciary commitment. Learn more at fermata401k.com. Fermata Tax, personalized tax services for yourself, your family, or your business with an emphasis on efficiency. Find out how at fermatatax.com. If you haven't already, like and subscribe to Fermata on the Markets on YouTube, Spotify, and Apple Podcasts. Fermata on the Markets features human hosts, editors, and voiceover talent. Music by Dr. Delight on Soundstripe, voiceover by Joan Alloway Nash. Thank you for listening to the very end. We appreciate diligent viewers and listeners. Fermata Advisors LLC is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempt from registration requirements. This content was produced by Fermata Advisors LLC, DBA Sonoma Wealth Advisors, DBA Fermata 401k, DBA Fermata Tax. The opinions expressed by Fermata Advisors LLC on this show are their own. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.